You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
In 1913, it was like around 60 cents. So if we use 100 as just saying it should be 100 times more than it is, that's 60 bucks. Now look, I'll settle for a $60 silver price as opposed to a $26 silver price, but it ain't 1,000.
Thanks for tuning in to Mining Stock Education. I'm your host, Bill Powers, and in today's show, you're going to be hearing from one of my close friends, Kerry Lutz of the Financial Survival Network. I daily chat with Kerry over the phone regarding the markets, metals, and mining stocks. Kerry has been a podcaster interviewing the who's who in macroeconomics and the precious metals sector and mining stock sector for over a decade. He also has a past of being a New York lawyer, and in that career, he worked in the heart of the financial district there in Manhattan, providing services to a lot of these hedge funds. And he also did a number of deals with those hedge funds and was quite successful. He doesn't brag about it, but I know a little bit about the backstory. So Kerry, you're a good friend. Welcome onto the show. And because of your knowledge of how these hedge funds work, when we look at what happened with the Wall Street Bets movement and, punishing the shorts, taking down the hedge funds and organizing this SilverSqueeze, one of the things you told me was not to look at it just as the narrative. There's often deeper layers as to what these hedge funds are doing to one another beneath the surface. Could you elaborate a little bit about this?
Yeah, well, I have this theory of business in America that every profession eventually eats its own. Lawyers suing lawyers for malpractice, for a whole bunch of other things. You got doctors testifying against other doctors as expert witnesses to get huge fees, and it goes on and on. And really, hedge funds are no different. If you've ever watched the show Billions, it's a fictionalization. It's silly in a lot of ways. But the one thing you get is they hate competitors. They hate each other. They might be in public drinking with one another, and then the second they're out of public, the shiv is stuck between the ribs. And that's the way that you have to understand exactly what the squeezes were and how it happened. And so Robinhood, I have no doubt, identified these stocks, whether it be at GameStop, AMC, Nokia, a bunch of dogs, even Koss. Now, Koss made the best headphones when I was like 15 years old. I didn't even know they were still in business, yet alone were like such a short target. I think they were from Milwaukee. Actually met Mr. Koss one time, and it was a great company in its day, but now it's like a dog with fleas. And so hedge funds, first and foremost, are opportunists. And I know these people. They were my neighbors. Like you say, I dealt with them. One hedge fund, I always joke with the owner, well-known hedge fund, used to say, I knew you before you were a billionaire. It's probably worth a few $100 million then. They look for opportunities. And nobody, there's been short squeezes throughout history, and really it's called forced buying, when a short gets squeezed and they have to buy into the stock at whatever price to cover their shorts. I sent you an article from Zero Hedge, which really, really summed up the practice. It's supposedly illegal in the US, but I believe that broker-dealers are still allowed to do it because they're supposed to get the stock and borrow the stock and then give it to the client, but they're allowed to naked short and then get the stock afterwards. And whether they do or not, the heck knows. It's definitely a frowned upon practice. But when you see a GameStop 140% short interest, that means that it's not just that there's 40% more shares that have been shorted than exist. All right. And then you get this phenomena of phantom shares. But even if there's 100% short interest, that means that every single entity loaned out their shares, and a lot of insiders won't allow it. And there's steps you can take to hinder the brokerage houses from shorting your shares. I don't want to go into it now. But if you're interested, you can find out. Send Bill an email, and I'll send you how you do it. But it's difficult. But the big players, the big insiders, can do it. So the concept of even 100% of the shares being shorted means there's naked shorts out there. Even at 100, probably at 50%, there could be. Now, when you sign your brokerage agreement, there's a little box there that says you can allow the brokerage house to loan out your shares to short sellers. And you could click that box or not click it. I don't even know if they do it anymore. It's been a while. Certain brokerage houses will actually give you part of their fee, because when you loan the shares out, you actually, the brokerage house gets a fee for this purpose. It's a pittance. It could be like 50 cents a share. It might be interest. I don't know exactly the mechanics of the brokerage industry, but you can actually share in the proceeds. I think Interactive does that. But then, then the fun begins. So other hedge funds identified vulnerabilities in a bunch of other hedge funds, and these vulnerabilities led back to the brokerage houses. They got into trouble, which is why they started the restrictions, because they had to up their collateral. I guess that goes with, I don't know where the collateral's held. I think at the clearinghouse, or some independent party holds their collateral. And when they see these situations arise where there's potential for fungus losses, because what happens when the brokerage house sends out a margin call, just like in reality, a lot of people don't pay it and they just walk away from their accounts. And when you see this, then the brokerage house is left holding the bag, and this could severely impair their capital, which is exactly what we saw with Robinhood and probably several others. And according to Nick Santiago, who actually worked on the street, there were a lot of brokerage houses exposed as a result of this, which is why you saw Robinhood recapitalize billions and billions of dollars. So it's a really interesting phenomena where we live, the world in which we live today, where the rules they apply to you and me. The little Robinhood traders, they apply to, but the big guys, they get a pass.
Is there any aspect of David versus Goliath here? Do you think that we could overlay that narrative on the last 2 weeks?
Well, in David's mind, he was going up against Goliath. In Goliath's mind, Goliath saw an opportunity brought on by David and jumped to the forefront. Then you saw what happened in the silver market, which is a really interesting situation in and of itself, because the physical disappeared from the retail market. We know, the same people as I do. They had no silver to sell. And then, you got the situation where it just went crazy. And you really had a split between the COMEX price and the retail silver price, and it still exists to some extent right now.
We'll be right back after this word from our sponsor. Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com. Do you think that mass buying and demanding physical bullion, is that the key to seeing a higher silver price? Because there was a lot of deflation emotionally with silver investors this past week.
Oh yeah, eventually when the individuals start doing it, then the big guys will demand delivery too, because they'll jump on and they'll see an opportunity go long silver and trigger all the shorts. I mean, it's a war going on here, Bill, and the Davids are kind of the foot soldiers, the sacrificial pawns who get slaughtered, while the big guys really hammer it out behind the scenes that you don't see.
Yeah, and I think we should point out, just so I don't get any hate mail or mean comments, listen, both Kerry and I own a lot of physical silver as well as silver mining stocks. So you're listening to two silver bulls talk, not two silver bashers. But at the same time, Kerry, are there any takeaways that silver bulls should take away from what's occurred in the last week for maybe some self-reflection?
I will go back to this guy, Charles Biederman, who used to be a guest on my podcast, and he said it best. He said, and this was years ago when silver really got slammed and it was down to almost single digits. He said, right now, silver is the worst investment in the world. One day you're going to wake up and it will be the best investment. We're getting close to that point now. Look, we know the big bullion houses, how many times have they been indicted for fixing prices? Now, the way that the government presents it, oh, this is a one-off event. And, I'm not saying that they totally fix the price every day. There are those who do believe it. But I do think they're kind of like the butcher selling you a pound of filet mignon, but having his thumb on the scale. That's the way I look at it. And they know through the algorithms, they know exactly the right moment to put the thumb on the scale or to load the scale down with substandard beef, and you buy it. So that's our disadvantage as individual investors and speculators in these mining stocks. But our advantage is that we can sit back and wait. You don't have to be persuaded by the noise. Whereas the traders out there, we saw that they can really get hurt when they're not properly cognizant of their vulnerabilities. We don't have those vulnerabilities in the long run, because assume that you're long silver for the long run. Did you sell any of your physical silver after what happened last week?
Not an ounce. It's in the same place it was before.
Exactly. And silver is really looks like there's a real support level at 26, whereas gold has been weaker. Its relative strength has been way weaker over the past several months. Silver has been hanging in there, going a sideways channel. When it does break, I think it's going to be massive. One thing I heard somebody say that, inflation adjusted silver should be 1,000. All right. So that triggered something when you and I were discussing it. I said, all right, so our modern inflationary era started in 1913. All right. The price of gold at the time was $20.20 some odd cents or 60. I don't remember the exact amount. Right now, the price hit 2000. Now it's pulled back a bit in the 1800s. Looks like 1800 is support for gold as well. But if you just say 1800 times 20, that's a 90-fold increase. And if you look at the statistics, they say $1 is worth 1 cent of what a 1913 dollar was worth. And it's hard to gauge that because of technology increases. Our productivity level throughout the world has increased so much. It's difficult to measure that, but let's just assume that that's correct. So gold's a little bit undervalued in those terms. Silver, on the other hand, in 1900, it was like $1.16 or 18. We had demonetization of silver where that was a whole long thing. You're interested in that, just look it up. William James Bryant, the whole battle between silver and gold. But in 1913, it was like around 60 cents. So if we use 100 as just saying it should be 100 times more than it is, that's $60. Now, look, I'll settle for a $60 silver price as opposed to a $26 silver price, but it ain't 1,000. All right. Now, granted, consumer price indexes are twisted and they're rough approximations, even when they're really accurate. So you could make the argument that really inflation, we're at 0.5%, right? You could make that argument, and I wouldn't dispute it because food isn't in there, energy is not in there in the CPI. So even if it was 0.5 cent that $1 today is worth as opposed to a $19-13 on the eve of the Federal Reserve Act being snuck through Congress, that would still be $4,000 gold and we're looking at $120 silver. I'm willing to say somewhere between $60 and $120 is the actual price of silver. Plus, we got massive inflation taking place now in every market, asset market, except gold and silver, in stocks, in artwork, in real estate. So, you have to take all these numbers with a grain because nobody really knows the right answer. But my feeling, $60 to $120, assuming that silver should be a hedge against inflation and should have its value adjusted. But we've also seen major increases in production, but major decreases in reserves. And silver, industrial metal, it gets used and basically tossed into the landfill in minute amounts. Supposedly there's companies that have a process to strip it out of electronics, precious metals. I don't know about all that. All I know is that silver by 1913 numbers is undervalued, assuming that it should have appreciated at the same rate of gold. And if it should have appreciated higher because there's less reserves, back then it was 15 to 1 or 20 to 1. Every 20 ounces of silver, you got 1 ounce of gold. Now it's 8. And these aren't numbers that I'm making up. Now, maybe they've got some way of creating silver nanotubes to use in electronics, cars and all that, solar cells, but they aren't using it yet. So by all rights, both metals probably undervalued, probably substantially. I don't know $10,000 gold, $1,000 silver, but we do know when markets get going, where speculation emerges, you can have massive increases that are well above the intrinsic value. And the good thing that came of Robinhood is the millennials, the Robinhooders, or as what's her name, Maxine Waters probably calls them Robin Hoodlums. They all of a sudden, en masse, became aware of an even more barbarous relic than gold. So this is an epiphany for the millennials. And I once laughingly wrote an article, the millennial generation is the next greatest generation. I mean, I have 3 of these millennials, my children. But this is an awakening to them that, hey, maybe Bitcoin, who knows?
Well, there's nothing like holding a silver bar in your hand, is there, Kerry?
No. And I keep a little silver bullet in my drawer. I don't know how it's going to come out. Maybe you can see it there.
I sure can.
1 ounce of pure silver. And because eventually it could be the bullet in the neck of the financial system, but we're not there yet. Not quite.
Okay, but silver is the safest and best investment, in my opinion, for the common man. And Kerry, would you agree with that?
I think, look, you wouldn't buy a house without having insurance on it for casualty, for theft, for fire, flood, whatever. You want to be insured. You wouldn't have a family without a life insurance policy if you're the sole breadwinner. To me, it's no different. This is the ultimate insurance policy, but it's an insurance policy that could also yield major riches. Your timing's right. If your selection is right, you buy those mining stocks at the right price, the right companies. All of these things are real difficult to do, but insurance is insurance. And you don't wake up one day and say, I haven't been robbed or had a fire in 42 years. My case here. What do I need insurance for? I'm just paying these insurance companies and they're just stealing my money. I'm canceling all my insurance. I have a disability policy, Bill, that I've had for 37 years, cost me a fortune. They call me superstitious. I could really get rid of it now, but I feel like the day after I got rid of it, I would get disabled, and then where am I now? So you don't just get rid of your insurance because things appear to be good. You hold on to that insurance because It's an unforeseen event. An insurable event is one that's unforeseen, unknowable, and that you can't prepare for other than to take out an insurance policy. So precious metals are the ultimate insurance policy against governmental stupidity, against geopolitical turmoil, against political uncertainty, all of which we're encountering now. So how could you not have some? And, the beauty of silver is you could go buy a roll of free 1965 quarters from your local coin shop. And what is that going to cost you? Like, I don't know, $50? And you could buy one of them a month or a week. You could just start stacking it up and just leave it someplace safe, and you're ready.
Excellent. That's great. We'll leave it on that note. Well, Kerry's website is financialsurvivalnetwork.com. His podcast is Financial Survival Network. It's found where all good podcasts are found. Kerry, thanks for giving us an overview of silver and sharing some of your thoughts in light of the recent event. We'll be talking to you again soon.
Anytime, Bill.